In just a few days, Bitcoin has wiped out all of its gains for 2026. At the same time, gold continues to surge, now pressing toward the $5,000 per ounce mark. And while markets are trying to make sense of this growing divide, something else happened at the World Economic Forum in Davos. Central bankers openly dismissed the idea that Bitcoin could ever challenge fiat money. They laughed it off. But unexpectedly, a strong defender of Bitcoin stepped in and calmly dismantled that argument from first principles. Today, we're going to break down why investors seem stuck in wait-and-see mode, why many are still bracing for a brutal end-of-cycle drawdown, and why there's a growing case that Bitcoin may have already lived through its bear market. We'll also explore what could finally push Bitcoin out of this long consolidation and into its first truly parabolic move in over 5 years, a move that could end up bigger than anything we've seen before. Now, let's get into it. This past week did real damage to market sentiment. Not only did Bitcoin erase its 2026 gains almost overnight, but gold's continued outperformance made things even more uncomfortable. And not just because gold is rising, but because Bitcoin failed to react the way many expected during periods of global stress. That leads to a difficult conclusion. It's becoming harder to ignore the idea that Bitcoin isn't just in a bear market now, but may have been in one for most of 2025. That sounds strange, especially after Bitcoin hit an all-time high of around 126,000 just 3 months ago. But the picture changes when you stop measuring Bitcoin in dollars and start measuring it in gold. When you do that, Bitcoin is down more than 50% year over year. That's a clear signal. During a time of geopolitical tension, monetary uncertainty, and growing distrust in the dollar system, Bitcoin has lost purchasing power relative to the world's oldest store of value. Here's where it gets interesting. Bitcoin and gold appear almost completely uncorrelated right now. When new tariff threats emerged earlier this week, gold rallied while Bitcoin sold off. When tensions eased, gold pulled back and Bitcoin caught a bid. One possible explanation is that markets are treating Bitcoin and gold as symbols of competing power systems. Bitcoin is being viewed, at least for now, as a US-linked asset, tied to American capital markets, innovation, and financial infrastructure. Gold, on the other hand, is increasingly seen as a neutral alternative, aligned with countries and blocs trying to reduce dependence on the dollar. That doesn't mean this framework is perfect, but it helps explain current behavior. And one thing is certain, gold's long history and familiarity still make it the default safe haven in times of uncertainty. Most people simply haven't put in the time to understand Bitcoin. And that becomes very clear when you look at what happened next at Davos. Every year, the World Economic Forum brings together central bankers, CEOs, and policymakers to discuss how the global financial system should work. This week, Bitcoin entered the conversation. During one panel, Coinbase CEO Brian Armstrong debated the French central bank governor on whether Bitcoin poses any real threat to fiat currency. And what followed was incredibly revealing.
People think about our current financial system as kind of sacrosanct and it's the only way to do it. But if you study the history of money, really it's got created in like 1971 when Nixon went off the gold standard in the US, and we currently have the system where most central banks don't have any link to a hard commodity underneath. I think fiat currencies are going to continue to exist for a long time, but we're also seeing the birth of a new monetary system that I would call the Bitcoin standard instead of the gold standard. And in the crypto space, that is a return to sound money and something that is inflation resistant, because democracies around the world, once we came off the gold standard, are struggling to balance their budget. They're all running deficits, and it's caused inflation in fiat currencies. And so there is a real segment of the population that is looking for a new system based on hard money.
Governor, you have to address this. Is the euro in danger from a Bitcoin standard?
No, I'm a bit skeptical, Brian. Sorry to say it about this idea of the Bitcoin standard. We left the gold standard, but the gold was only a technical mean. What is important is what you say, Bert, that monetary policy and money is part of sovereignty. And we live in democracies, and I think the public role is key. And if we lose that, really you lose a key function of democracy. That said, I always keep repeating that money, as long as it exists for centuries, has been a public-private partnership. You need a public anchor, whatever its form is. Remember, and silver and gold were sovereign assets, so it was on the public side. And then you had banknotes, and you will have CBDC. But anyway, the most important part of payments is in the private sphere, and this is the development of tokenized private money. But this tokenized private money must be regulated to inspire trust, confidence. And this is another danger we should treat, that tokenization could develop, if not safe enough, financial risk. With the multiplication of stable coins, which are very different, which are fragmented. This is the issue, Bill, you mentioned. And so we must have safe enough regulation. This is MiCA in the euro area. This is now Genius in the US, which is welcome. Because if stable coins are not enough, we could have the risk of a somewhat Gresham's law, you know, this famous one, that the bad currency is more used for transaction and the good currency, which would be CBDC, would be kept for store values. Right. So I think we are on the right track to regulate. We could improve MiCA, still more improve Genius perhaps. And the question of compatibility you raised, we discuss it in the BIS. I happen to chair the BIS. There is a so-called Agora project, and we will discuss it in the G7 in the French presidency. Right. But regulation is not the enemy of innovation. Once more, it's a guarantee of trust.
It's fascinating that you say that. Brian, you mentioned a complementary role that you could play. Is there a complementary role in Europe when there's so much regulation and it is about the digital euro?
Yeah, I actually think these are very positive sums. So crypto just broadly is a technology to update financial services. So it's going to help with stablecoins and tokenized equities and crypto assets and trading. And by the way, borrowing and lending is also getting updated. So I think that crypto is very good for fiat currencies. It's very good. Bitcoin is good as a check and balance on deficit spending, because when there is a lack of trust, or people, from like in a U.S. context, if people are worried about inflation, or maybe in places like Argentina or Turkey or Nigeria, they are going to flee to the thing that they believe is going to store value more. So I think in general it's going to be very complementary, and like you said, I think it comes down to trust. And so if fiat currencies can maintain trust and not have the money printer kind of debasing everybody, then they'll survive. But if countries that have bad behavior on that dimension, Bitcoin doesn't have a money printer. The supply is fixed, and people will go to it in times of uncertainty, kind of like they did with gold.
The guarantee for trust is independence on central bank side. And we have a core mandate, and we are accountable to that. But sorry to say that I trust more independent central banks with a democratic mandate than private issuers of Bitcoin, which have a very useful role. But
Bitcoin is a decentralized protocol. There's actually no issuer of it. So that's in the sense that central banks have independence. Bitcoin is even more independent. There's no country or company or individual who controls it in the world. And so anyway, I think it's a healthy competition, because if people can decide which one they trust more, and I think it's actually the greatest accountability mechanism on deficit spending.
But the most revealing moment comes when he laughs at the idea of Bitcoin being in real competition with fiat money. Because here's the truth. Central bankers don't laugh at things that aren't a threat. They laugh at things they haven't been forced to take seriously yet. That's not the behavior of a system that has already won. It's the behavior of a system that hasn't felt real pressure, at least not yet. And that brings us back to the market. Right now, investors are completely frozen when it comes to Bitcoin. They're waiting to see if the traditional 4-year cycle still holds, whether a brutal 70 to 80% drawdown is still somewhere ahead. They're also trying to figure out what Bitcoin actually is in this environment. Is it a risk-on asset, a safe haven, or something entirely new? That uncertainty is exactly why price action has stalled. When markets don't know how to categorize an asset, they hesitate. And hesitation shows up as sideways movement, weak conviction, and choppy price action. Which brings us to something very important, Cathie Wood's comments on a recent CNBC interview. Because what she said may help explain where Bitcoin is headed next.
What do you make of all the volatility in Bitcoin, and where do you think it's going from here?
Yeah, I think that a lot of people maybe do not know much about or understand what happened on October 10th. There was something called a flash crash. It had to do with a software glitch at Binance, and it caused auto deleveraging. And that was a shock that hit the system that has been reverberating as over-leveraged entities are trying to get themselves straight. We think that is playing itself through. In fact, we think it has played its way through. By some estimates, $28 billion of damage in that auto deleveraging cycle. I think we're through that. I know there's a lot of fear about the 4-year cycle. We didn't have much of an upcycle by Bitcoin standards, so we think we're pretty well through the down cycle here. We may test in this 80 to 90,000 range on Bitcoin, but we do think that the test will be successful. It will be the shallowest 4-year cycle decline in Bitcoin's short history, and then we're off again. We think this is 3 revolutions in one: a global monetary system, rules-based, competing against fiat currency, to be sure. It is a technology revolution, and it is the leader of a new asset class, which, surprisingly, and I put it in my New Year's letter, Bitcoin and gold are not correlated with one another. Even though everyone calls Bitcoin digital gold, there's a 0.14 correlation between the two over the last full market cycle.
I guess I would respond to that by suggesting, okay, if I agree with you on that, Bitcoin, or at least gold, is proving itself to be a safe haven asset, I think it's fair to say, whereas Bitcoin, which you suggest is growing in its role as a safe haven asset, doesn't seem to be much of one, considering it's going to be 7 straight down days. And if ever there was going to be a rush to safe haven assets over the last couple of days, wouldn't this be it, where Bitcoin would be getting a boost from concerns over more tariffs in Greenland and upset market? And it's not.
Yeah, if you take from the end of the equity bear market in 22 to today, I put this in the letter as well, gold has appreciated, or it had appreciated at that time, by 165, 170%. Bitcoin had appreciated by 360%. So it had done a lot of work coming out of the bear market as a risk-on asset. We get institutions now moving into Bitcoin, starting with the spot Bitcoin ETFs. And we have a whole new investor who basically is told, as it is being introduced to this new asset class, there's a 4-year cycle out there. And so I think what has happened is we didn't have the big up move around the ETFs that many expected. And we have institutions biding their time, just trying to understand the asset class, trying to understand this 4-year cycle, and trying to understand if they're going to be caught in a 75% down round. We don't think they are, but they certainly are doing their homework, which is great. And we think Bitcoin is both a risk-on asset and ultimately a risk-off asset, especially if you're looking for a hedge against inflation. It's mathematically metered to go up now 0.85% per year, and that's a lower growth rate than gold. But it's also a hedge against deflation, because in periods like 0809, there's not the counterparty risk in Bitcoin, that transparent network that we saw in the banking system back then.
I love the way Cathie Wood forces everyone to zoom out. It's easy to pull up a chart from 2025 and declare that gold has crushed Bitcoin. But when you zoom out further, an entirely different long-term story appears. Cathie also echoes something, that we're likely at the tail end of a Bitcoin down cycle. And when you layer that onto what Bitcoin already did in 2024, it starts to make sense. This cycle was front-run. For the first time ever, Bitcoin hit new all-time highs before the halving, driven by ETF approvals. Then it ripped past $100,000 in December 2024 following the Trump inauguration. That's why the idea that 2025 may have been the bear market for this cycle isn't crazy at all. In fact, it explains a lot. Long consolidation, heavy distribution from long-term holders, muted upside, and constant frustration. Bitcoin did a massive amount of work early in the cycle. Now gold appears to be front-running the next phase of the monetary transition. And that doesn't invalidate Bitcoin. It actually validates it. Gold expanding the store of value trade makes it easier, not harder, for capital to eventually flow into Bitcoin. If Bitcoin didn't exist, let's be honest, most of us would be gold bugs. Gold is the on-ramp. Bitcoin is the destination. A shiny rock as the monetary base in the internet age just doesn't scale. The longer Bitcoin consolidates while volatility compresses and gold runs, the more powerful the next move becomes. And here's something most people haven't fully grasped yet. In 2025, Bitcoin was less volatile than Tesla and Nvidia, assets owned by over 60% of Americans. Meanwhile, Bitcoin is owned by just about 12%. That's maturation. Lower volatility and deeper liquidity are exactly what larger players, institutions, sovereigns, and eventually nation-states need to enter at scale. Adoption happens gradually, until it doesn't. If there's one takeaway here, it's this. Structure now matters more than short-term price moves. This phase of Bitcoin isn't about trading. It's about positioning. For families, businesses, and corporate treasuries thinking in decades instead of quarters, strategy matters. So to wrap this up, Bitcoin doesn't need central bankers to believe in it. It just needs time. Gold is doing its job right now. Bitcoin will do its job next. Being early never feels good in the moment, but it always feels obvious in hindsight. Stay humble, stay solvent, because the longest consolidations tend to produce the biggest repricings. Now I want to hear from you. Do you think we're already at the tail end of a Bitcoin bear market? And what do you think will be the catalyst that finally pushes Bitcoin into its first true parabolic run in 5 years? Drop your thoughts in the comments, and if you found value in this, like the video, share it, and don't forget to subscribe so you don't miss what's coming next.